Hello. We are going to be working our exam for exam 6. So if you go out in Blackboard and print out exam 6A, right? So go out there to where we've got the practice exams. There's 3. There's one that's practice exam 6. There's one that says 6A and one that says 6B. So this is exam 6A. So we're going to work the problems in it. They'll be similar to your exam problems on exam 6 that we're going to take that Tuesday when we come back from Thanksgiving, December 1st. So do not forget, come back from Thanksgiving, we have exam 6. It'll be pretty similar to this. So the first thing we're going to do are some stock transactions. So don't rely on this being exactly the same thing with just different numbers. You know, it could be I'll ask you to do some preferred stock, or it could be I'll ask you to do some common stock, you know, do some dividends or something. But it'll be a series of equity transactions, whether it's preferred or common. I don't know, make sure you understand both of them. Maybe it will buy or sell some treasury stock at a gain or a loss. So go back through the homeworks and make sure you understand how to do that. And we'll practice this one. Alright, so problem number 1. Stock transactions. Following accounts and balances are in the book. So the company itself, if you were to look on the owner's equity portion of the balance sheet, you would see that they already have common stock outstanding with some capital paid in excess of par and some retained earnings. So this is important because you may need to know, you know, if you try to do some dividends or something, how many shares are outstanding. Are they common stock? Are they preferred stock? You know, what's going on? So that's what we know about this company. Then they did some transactions over the course of the year, A, B, C, D, and E. So let's just check out those transactions and work those. All right, let's do the first one. Issued 350,000 shares of common stock at $21 per share, receiving cash. So if you'll recall, some stocks have a par value, some have a stated value, so we have to record anything in excess of the par or stated value separately. So it's 21, and let's look up here, up $15 par. So yeah, so there looks like there's about a $6, or not about, exactly, $6 per share in excess of par. So we need to recognize that. Maybe we need to calculate what that is real quick. So let's figure out, I think how we did it for the homework was we'd figure out what's the cash we're getting in, and out of that cash, how much is going to the common stock and how much is going to paid in capital. So let's just calculate that real quick. So the cash is $21 per share for 350,000 shares. So cash, 350, right, times $21 per share is equal to $7,350,000 in cash. So that's what we're getting in cash. Of that, $15 per share is the par, is the common stock. So the common stock is that 350,000 shares times $15 per share, and that's going to equal 5,250,000, right? So the difference is the excess of par, so that's that 350,000 times the difference, right? $6 per share, which is equal to 6 times 350,000 is going to be 2,100,000, or you could just subtract the difference between these two and you'd get the same deal. So for our journal entry, we're going to get in cash of 7,350,000. Of that, 5,250,000 is going to go to common stock, and 2.1 million is our capital paid in excess of par. So let's just do that journal entry. And that was, I guess it's not really a date, we'll just call it A, because that's what it's called on the exam. So we know we get in cash of 7,350,000, right? And we know that on our equity we're increasing common stock. And we figured that out as 5,250,000. And then the capital paid in excess of par common, right? Because sometimes there's preferred. We know is $2,100,000. All right. So there we go. There's our debit. Our two credits equal our debit. So we're done with transaction A. Let's look at transaction B. Purchased 30,000 shares of Treasury common stock for $25 per share paying cash. So you may recall that sometimes, from time to time, companies go out on the open market and purchase some of their own stock. Just buy it back. And they pay for it whatever the market is, and at that time, that was $25 per share. So this is just buying some Treasury stock and paying cash for it. So all we really have to figure out is how much cash. 25 times 30. Right? So that was for A. This is for B. So $25 per share times 30,000 shares equals 750,000 in cash going out. So we're going to get Treasury stock in, cash goes out. So for B, we would have Treasury stock. Some people would list this as common. If they did have preferred, they could buy back their own preferred, and cash. And we said that was 750. All right, so there's transaction B. Let's see what transaction C is. Sold 20,000 shares of the Treasury common stock for $30 per share, receiving cash. So this is interesting. When we bought that Treasury stock, instead of the Treasury stock being par now, it becomes $25. So instead of a $15 par, it's like it's got a $25 Treasury stock value. So it's no longer a par value, it's got a Treasury stock value. So $25 per share is what we've got to bust out of there, because we're actually going to get 30. So we're going to get a little gain on the Treasury stock, or what we call paid in capital excess of Treasury stock. All right, so let's figure this. So just like when we do the common stock sale, we have to figure out how much cash we're getting in. All right, so for cash, we're getting 20,000 times 30. Shares times 30 per share equals 2 times 3 is 6, so that's $600,000. All right, and now we need to know what's the Treasury stock value, right? So that's still that 20,000 shares times 25 that we paid for it, right? So 20,000 times 25 is 2 times 25 is 50, so 500,000. So Treasury stock is 500,000. So that excess, that capital in excess Treasury stock is the difference, right? Or that 20,000 times $5 per share, or you just subtract 600 from 5,000, and that's 100,000. All right, so cash coming in, 600,000. Treasury stock getting sold, going out, 500,000, and our capital in excess of Treasury stock, 100,000. So let's just do that transaction real quick. So we sold it, so we know cash is coming in, and we said the cash coming in was going to be 600, right? And we know we're selling Treasury stock, so it's going out. right? And that was 500, right? And that capital paid in excess treasury was 100. All right, and of course they debits equals credits. So it looks like we're good with transaction C. What's next? Declared cash dividends of 4 cents per share of common stock. All right, so we have to figure out how much cash we're going to pay out. Well, we're going to pay the cash later, but we declared it. How much do we declare? What is our dividends payable, right? So 4 cents, we got that, but how many shares are outstanding? We're going to have to do some adding and subtracting, looks like to me. All right, so we had outstanding already 3 million, right? So we had 3 million. And then we bought back some treasury stock. Oh, no, we issued some. For next we issued some, so we got to add 350, right? So 350 we put out there. So we put 350 out there in the world. Then we purchased 30,000. So we took that out of the world, right? So this we had out in the world to begin with. Oh no, not 3 million, 1,000,005. That's the authorized. So don't make my mistake. 3 million are authorized, 1,500,000 is what's actually outstanding. Plus 350,000 we issued, minus the 30,000 we brought back in. Sold, so 20,000 went back out there in the world. Right? So actually what we have out there in the world is 1,500,000 plus 350 minus 10,000. Plus 340. So, sounds like 1,840,000 is how much stock is out there in the world. 1,500,000 plus 340, right? We had a net 10 come back in. All right, so that's times 4 cents a share. 1,840,000 times 0.04 is equal to $73,600, right? 1,840,000 times 0.04 equals 73,600. That's our dividends payable, 73,600. So let's do that. All right, so we declare cash dividends. Remember, sometimes you can have stock dividends, cash dividends, right? And then we have that liability, dividends payable, right? And we said it was 73,600. All right, and the last thing that we are doing on this problem is we pay the cash dividends out. And so pay dividends with cash. Dividends to the liability is going down. All right, that's it. We worked problem 1 from exam 6A out in Blackboard. And again, I caution you, remember, you could have preferred stock transactions or maybe stock dividends paid out. Who knows? So anyway, but that's how you do that example problem. But make sure you go back to the homework and work all of those too, just to be in good practice with any kind of stock transaction that might come up.